Are you interested in investing in real estate, but you're not sure how to start? Or you're a real estate agent and you want to help your clients invest in real estate? One of the misconceptions is that real estate is for professionals only. There's a lot of complications, a lot of possible setbacks, and a lot of risk. That is not the case. Most real estate investors out there are actually individual homeowners that decided to move from a property and rent it out, or buy a property and kind of create this passive income, which is a great idea. That's what I'm going to talk to you about. But it's not as risky as you think. It's not as complicated as you think. The amount of return that you can get is incredible. It's one of the best ways to create and build wealth as an average person having a regular job, as you've already seen in your own property, most likely, how that investment has basically provided a ton of wealth for you and net worth. So let's go through what it means to invest in real estate. And hopefully this will answer a bunch of questions that I get asked all the time. So let's start first of all in terms of a strategy of retirement, of building wealth. What should you be doing in order to get to that point where you can retire and you've invested in the right things? So about 25 years ago or so, when I was getting my MBA, I went through a finance class and I was taught this. And I've actually heard other financial advisors talk about the strategy that I'm going to tell you about. I have to give a shout out to Brett Mills, for example, who's out here in my area. He's got 900 doors, 900 investment properties, or at least, if it's a bigger complex, 900 doors that he's invested in as he works his regular full-time job. And is he so wealthy, or at least when he first started out, to be able to do that? No. He took what I'm going to share with you as a strategy to buy one property, then the next, and how to leverage that so that he's not too leveraged and not taking too much risk, but he's building and growing a portfolio that's going to give him not just great retirement income, but a legacy for his kids as well. So let's go through what that first strategy is all about. So this is what I learned from my finance instructor and others that have been out there. And like I said, I gave a shout out to Brett Mills because I saw him talk about that as well. If you're putting together an investment strategy, meaning your retirement saving strategy, or whatever you want to call it, it's really divided up, if you kind of have this pie diagram, into three main categories. Over here is real estate. All of the most wealthy and successful people out there spend or put about 50% of their investment into real estate. It's such a secure way to invest because it's real property. You invest in a company, the company could go under. Not that you shouldn't do that, obviously, because we're going to talk about these other areas, but real estate investment is one of the most secure investments. Over the last 52 some odd years that it's been recorded, even though we've had some blips go down, real estate has continued to just go up and up, if you imagine this on some sort of long-term graph. On average, real estate is appreciating. I shouldn't say appreciate. Equity is being built on average about 5% annually on property. When I say, equity, we're talking about what you can get from cash flow if you're going to rent it out, what you're going to get in terms of tax benefits, owning the property as your own or even as an investment. And then, of course, the two big ones are how much it appreciates every year. And then there's the principal buy down when you leverage a bank's loan. And we'll talk about how all those work together towards this kind of return. But please understand and don't, jump off of this because this 5% is about the overall appreciation or equity, building of that property, but you're not putting in the full amount in order to invest in that. So that's why this 5% actually can become more of like a 25% annual return on your property investments as I show you what to do. So pay attention, be patient with me as I go through all this. I have so many clients. I just sat with one last night, asked me how to invest in their first property. And as I went through this, I realized people need to see this at a bigger scale. And I'm going to try to help share this with you. And I'm sure others have done this as well. But this is my way of trying to get this out to the masses. So and I've done this for the last, few decades or 2.5 decades. Half of my investment money, whatever that is going into real estate. 25% of it goes into stocks. And when I say stocks, we're talking about, anything from your international stocks, your blue chips, your whatever you feel comfortable with. It doesn't matter if you're really conservative or if you're a little bit more aggressive. Basically, this is kind of the bucket that you would put that in there. Most likely, if you're investing into a 401k or other type of retirement fund, you've got some sort of portfolio of that maybe even an advisor is working with you on to determine what you feel most comfortable with. This could be an ETF that's based on an index like the S&P 500, something as basic and simple as that, all the way to you actually buying and selling stocks because you feel comfortable doing that all on your own. If you like Tesla or you like Google or some of those other, big chip, blue chip type of stocks, you can, invest in whatever it is that you want here. But those are the stocks. And then you have another 25% in what's called commodities. So basically, your stocks and commodities work not against each other in any way, but when stocks go up, usually the commodities start to go down, and when the commodities go up, the stocks go down. So basically, what I've learned here is that when my stocks go up by 10%, then what I'll do is I'll take that profit. So that's when I sell my stocks, and I'll buy with that money commodities. And same thing with commodities. When my commodities increase by 10%, then I'll take that profit and then I'll put it into my stocks, because basically the market tends to go up and down, and as commodities go up, stocks go down, and vice versa. So this has been a really good strategy for me to plan for my retirement or our family's retirement in terms of how we manage the buying and selling of these stocks and commodities. Now, when I say commodities, just to be clear, this could be anything from like gold and silver. You've seen how those have gone up quite a bit recently. It could also be investments in oil, or just if you understand what a commodity is, agricultural things like this. That's what I mean by commodities. Okay, so you've got a portfolio now where half of your investment every month or whatever you do in terms of when you invest, real estate, 25% in stock and 25% in commodity. This is a really good formula, and it's very basic too, of where you should put your money when you are saving for the future. If you're only saving $150 a month, because you're brand new in the workforce or maybe even still in school or something, that's fine. All the way up to saving thousands of dollars. Maybe you're at a point where you can save $5,000 a month or something like that, because you're that far along in your career, or you don't have as many expenses, you paid things off and things like that. But it doesn't really matter. You're still going to distribute it evenly between these three. Now, how are you going to buy a property for $150 a month of an investment? Well, maybe you're buying your first property. You're going to put just enough in here, right, until you can do that initial first down payment. Usually, if you're working with us, or we'll talk to you about in the future in other sessions like this, how you can get into low down payment, even zero down payment on your first property, take advantage of first-time buyer grants. You can rent out part of the property and hack into that property, so to speak, so we can talk about that. But you really want to start getting into ownership, property ownership, as soon as you can, as long as, of course, you're taking the right precautions to make sure that you're not taking too much of a risk, or what you feel comfortable with. And we'll talk about that a little bit more in detail here, as well as in other sessions. But I just wanted to kind of point out first, this is kind of the rich man's strategy, if you've seen something like this before, of how to invest in the future and save up for retirement and things like that. This is kind of the makeup of how that could be done. And it's worked really well for me and many others that I've talked to about, that being their primary way of investing. Okay. So now let's kind of go more specifically into the real estate side of things. Now, I do want to emphasize that some of you may be fearful of investing in property because you've heard of all of the scary things out there. Someone doesn't pay, you can't get it rented, someone's going to destroy your home, and all these type of things. There are ways that you can protect yourself against most of those things, and with insurance, getting the right people into your properties and things like that. But I will tell you, as everything does have a risk, so obviously there is a risk involved. We take risks in everything that we do as we earn our money. Even the job that you have, there's a risk involved. Is it possible that you lose that job or they lay you off? Of course it is. Is it possible that you don't get the, kind of raise or whatever that you want? So thinking about the amount of time that you spend to earn the money that you do, and the amount of return that you can get from that compared to your investment in real estate or in stock or commodities or whatever that is, the the risk reward is quite strong within real estate. So I'll go through this a little bit more so you can understand what I'm saying, but please at least give me the opportunity, or whoever you're working with, to explain why real estate is such a great investment opportunity without it being so risky or so scary that you don't even want to consider it. So at least put aside the fears for a minute, and let's go through what you can do to put yourself in a position to really make a lot of money that is very passive in terms of how much effort you have to put into it. And most of you that are probably watching this already know it with your own property. If you've owned a property now for 10 years, you're probably sitting on hundreds of thousands of dollars of equity that honestly you didn't really do anything more than you're paying your monthly mortgage, right? But you have to live somewhere anyway, so it's a living expense that you would already pay, and that's what you're leveraging. And you're getting a very low interest rate loan because of the asset that it's being loaned against. So just trust me as I go through this, that real estate investing is a very secure and a very big reward compared to risk opportunity. Okay, so now let's talk about how to get into that property without having, like the investment property, I should say, without having to come up with a whole bunch of money. So I want to go into the way you manage your finances at home. So in a business, you won't find a business that does a checking account and a savings account. So typically, and the way we've been taught from our banks, they want it is that we have a checking account. So we'll just kind of put a line here, and then we have a savings account. Okay, so we'll put checking and savings. Okay? And that's what the banks want you to do, because when you put money into the bank, right? This is all based on putting money into a bank. When you put money into a bank, your checking account is really not going to earn you anything. As a matter of fact, some banks will even charge you to have your money in their account so you have access to it whenever you want. As crazy as that sounds. Other times they give you lots of perks and things like that that they think attract you to putting your money into the checking account. But as far as earning interest, you're not even going to earn enough interest to actually pay the increase in inflation. Right? If inflation is around 3%, we want it to be around 2.5%, obviously. But let's say it's even at 2.5%. I bet you your checking account is not paying you even 2.5% on your money in there. So you're basically losing money that's sitting in your checking account because you're not even covering what the inflation is if you leave it in there. So what we do a lot of time, and then as far as your savings account, same goes for that, 2.5%. You might find a savings account if it's a high yield one, and you have certain restrictions or requirements to get that 2.5%, but most likely you're under 2.5% on that as well. So think about the way you manage your money at home. You're most likely putting, every single time you get paid, money goes into your checking account, right? You just put it in your checking account until you have to pay bills. So it increases during a period of a month, because usually you're only paying bills once a month, right? Your credit card bills, your mortgage payments, your car payments, whatever that may be. So you're letting that money sit in there. And let's say, for example, that you make, or bring in $10K a month. So every month you're pushing $10,000 into this checking account. Now at the end of the month, usually a lot of times it's a net 30 or so. So you might even have more than a month, in some cases a month and a half, before things that you're buying now with your credit card are even coming due, if that makes sense. So you've got money that's being put in here, and it's just sitting there until you've got to pay those bills, and then you send it out to pay bills, right? Pay your expenses on a net 30 or something along those lines. And let's say that you get $10,000 every single month, but you spend $9,000 in bills. So this amount right here is all going to your bills, right? Coming out here to those bills. And then you have $1,000 a month that you're basically living less than it's right. What it's costing you in terms of all your expenses and things like that. Hopefully, your budget is less than your actual income, so that you actually are not losing money every month, right? If you get that. So what do you do with this $1,000? Well, most people are taking this $1,000 and they're putting it into their savings account. So every month you're accumulating $1,000 a month, which is really good. And we feel really good about that. The banks even want us to feel good about it too. We look at our savings account. Wow, we got 1,000, after 10 months, you got $10,000 in there. Now then something comes up, or you decide to go on vacation, you decide to, buy something nice. And a lot of times, if you think about it in terms of how we consider our money, when we start seeing money adding up over here and it doesn't have a specific purpose, other than just having a reserve in case something were to happen, it's so enticing to say, wow, let's go on a nice big vacation, or let's buy that new car or that new boat. We actually end up spending a lot of our money, discretionary income, what's left over after all of our expenses, on things we don't really need or want. And we do it consistently because we see this kind of thing happening. The bank wants us to do that. Well, they'd like you to save as much as possible so they can use it, but our economy thrives off of this. This is kind of what we've been taught that we should do, right? And we end up falling into that. No business ever runs themselves like this. No business would just leave money sitting in an account, making even less than inflation would even cover, as they cover their expenses even. They wouldn't even leave money in the account to pay for their payroll. They have what's called lines of credit. So what I'm going to say is that, and you'll understand what I mean by buying property as soon as I help you understand how to manage your finances, because this is literally the worst way for you to manage your finances in terms of the expenses that you're paying, the money that you're saving, the interest that you're paying on things, et cetera, the money that you're not making from the money that's there. Money should always be working for you. So I'm going to erase this right here, and I'm going to show you a new way of managing your money. And what I want you to think about is a line of credit. Now, for those of you that don't have a home now, you're looking at buying your first place, don't worry, we'll cover that. But what I'm kind of mostly talking to are those of you that have owned a house probably for the last 5, maybe 10 years, and it's increased significantly in its equity position. The average US homeowner right now has 300,000, more or less, right around there, in equity of their home, right? Now, if you think about that equity, if you live in that house, how much of that equity is working for you? Meaning, what kind of interest rate are you making as an investment with this $300,000? I'll give you a second to think about it. If you came up with zero, you're right. 0%. You're making absolutely no money off of that equity. Until you sell your home, as you know, nothing is going to come out of this equity or building that equity. Now, the house itself will appreciate overall, but that equity from that appreciation or from the equity gain is itself not earning you any money. Okay. And I know you're thinking, well, how do I do that? I mean, if I get a HELOC or something like that, I'm borrowing against it. But I'll walk you through that. But I just want you to understand that $300,000 that you have right now in your home, in terms of your home equity, is literally doing nothing for you until you sell that house, and then you just cash out and receive it and decide what to do with it from there. At the same time, we have our mortgage payments, right? And you might be thinking, oh, my mortgage is awesome. I've got a 3.25% interest rate on my mortgage. I don't even want to get rid of my house because I've got such a great mortgage on it. That's why a lot of people are hesitating to sell their house and buy a new one, because I can't get a better house than the house I have right now for the money, because housing prices have gone up and interest rates have gone up. It's just so expensive. But I still have this $300,000 in equity that's not doing anything for me in terms of growing my wealth, right? So what happens is that on the other side of this, we don't put it together. We have all of our loans and what we borrow, right, in order to have things like cars, other, boats, RVs, stuff that you do like that. We might have loans that are out on credit card, okay? And then we have loans that are out there on like student loans, stuff like that. So all these different payments that we're making each month, many times we're not making in full. Some of you may have all those paid off, awesome, but most Americans don't. As a matter of fact, the average American has 111,000, the last I saw, in basically this kind of revolving debt. And I know that might sound like a lot, and you're like, wait a second, I don't have $100,000 in debt. You buy one car nowadays and you put it on a monthly payment, whether you're leasing it and it's not going to really be owned by you, it's still a payment that you're making that has a cost to it, or you're buying your car. Many times you're paying for this car every single month with an interest payment that goes along with it. Credit cards are around 25%, sometimes even more. You know, your student loan may be at a good rate, but it's probably around 7, 8, 9, 10 or so percent. You have to check with them to know if you're getting some sort of, you know, deal that, you know, you were able to get at the time that you got that student loan, or that's going with prime rate, you know, or something like that. But you have all of these payments that you're making, and there's an interest component to that. We think about the 3.25% mortgage interest rate, but when you blend it with these kind of payments that you have over here, most people on their overall payments have what's called a blended rate of around 12%. So you're paying around 12% in total interest across your mortgage and all the other loans that you may have. Okay. Again, you may be in a different situation, but this is kind of the average that's out there. So let me talk about what it means to manage your money in a different way, paying things off. Because first of all, you want to pay off any high interest that you can. This is not high interest, but those other things are. How you can pay that debt down, as well as how you can invest in other properties. So what I'm going to recommend to you is I'm going to talk to you. So remember, we had the bank over here as a, you know, that when I drew that line before, and then you had your two accounts. Now I'm going to call this a HELOC or something similar to that. But basically what HELOC stands for is a home equity line of credit. It's a line of credit. That's how most businesses manage their expenses with their incomes, right? It's a line of credit so that their money, in terms of their margins, right, their profits, it's out there working for them all the time. They're never going to let money just sit in an account, pay off bills at some point, pay off payroll. They have lines of credit that take care of that. They do have to borrow against those lines of credit, but the way they've set it up helps them to be able to do that and still make better margins in terms of their profit. Most of your big companies, your Walmarts even, don't make the money like you might think off of the products that they sell in their store. Their margins are actually very small there. They actually make most of their money on their money that they're doing, you know, net 30s back to their vendors, for example, or the, you know, the suppliers of the goods, because they want to make sure their money's always out there working for them. They can imagine billions of dollars sitting out there in investments that's going to make more money than the margin that they need to make on a box of Pampers, for example. Hopefully that makes sense, but let me get back to what it means in terms of this HELOC. So on a HELOC, below this line is basically your line of credit, okay? So this is the line of credit. That means you have access to this money if you need it. Now, they're going to tell you that anything that goes above this line is going to cost you, let's say, 7% right now, right? And there's introductory rates that are lower. This really depends on the going mortgage rates at this time. It's usually at prime plus a little bit of more on interest. Like you might be able to buy a house right now at 6.5%. Or 6%, but you're going to pay a HELOC around 7%. So those are going to be a little bit more. But this is a lot lower than what you'll get a credit card for, or other types of loans that don't have a kind of a real asset to collateralize itself against, right? So that's your home is a collateral, right, that it uses to give you a lower interest rate, because if you decide not to pay, you know, something happens, they can take that home from you, okay? So anything above this line is going to cost you 7%. So here's what I'm going to suggest in order to buy that first property, to help you understand how I buy multiple properties, how, you know, Brett's probably started, at least when he bought his multiple properties. It's not like we have a silver spoon and we had hundreds of millions or millions or tens of thousands even of dollars just sitting there waiting for us to invest in these properties. We had to leverage bank loans and our, you know, investment money that we have into these properties. And then we go from one property to the next, and we continue to build and grow our portfolio and our wealth through that, you know, that effort. So whenever you borrow against that, it's going to come up above it, but we know that we're going to have to pay 7% for that. So if we're not making more than 7% on what we borrow, then that's an expense. It's a cost to us, and we don't want that. We're investing, right? We're not spending just for the sake of spending. This isn't vacation money. This isn't, you know, even cars that depreciate. This is about appreciating assets like a house that we want to invest in. And it has to be at a higher rate than 7%. Got it? Okay. So when we buy a property, so if I want to buy a property, I'm going to have to put a down payment. So my HELOC is basically going to be used for my down payments on that property, right? Okay. So see if you can follow me on this. If I want to buy an investment property for $500,000, I am likely, as an investment, as an investor and investing in that property to get that kind of loan, I'm going to have to put 20% down, okay, to get that loan. So that means I'll pay $100,000 for that investment. Got it? That's 20% of $500,000. So this is what's coming out of pocket, okay? I'm not going to pay $500,000. I've had actually people ask me that have basically saved up, all the way up to close to retirement, and they've literally got $500,000 sitting in a savings, or even if it has some sort of stock investment or something like that, but it's not making as much money as they thought. And they're like, okay, I'm going to buy a property. That's a good idea. I haven't followed that model. Remember, I showed you that model of 50% being in real estate, and then I have my stocks and my commodities. So I like this idea. So I'm going to put $500,000 into a property, invest in it, and then I'm going to get some sort of return, a dividend, which is one reason that it's really good to have property, of whatever rent someone's going to pay me for that. And I get all of that money instead of it going towards like a loan. But the problem with that is that you're only going to make, on average, like I said, 5%. Well, I could probably make better than that in the stock market, depending again on how aggressive you are, but usually between stocks or whatever and the commodities, I would like to do a little bit better than 5%. So it doesn't sound like a good idea to buy property if I'm only going to make 5% a year on that investment. It does compound and everything, but it's still not a lot of money. So if I only put $100,000 down out of pocket, and that $500,000 property appreciates at 5%, because it's the whole value of the property that's appreciating, I'm going to have a $25,000 appreciation gain, or let's call it equity gain, because I'm considering in this, if I have some cash flow, if I have some tax benefits to it, as well as the appreciation of the property, as well as principal buy down, because I'm going to get a loan on the rest of it, and I'm going to pay down that principal every single month. So this is basically, it's compounding, but I'm anticipating about a $25,000 a year gain on average. Remember, some years might not be as high, some years could be quite a bit higher. We've had, like right now, we're about 2.5% in some markets of appreciation gain. It's really low. Things are a lot more flat. But then we also had 4 or 5 years back, 20+%, increases. So again, this is averaging out over that long period of time. So if I can get $25,000 out of my $100,000 out-of-pocket expense, if you think about the percentage of gain, because there's $100,000, so making it even numbers, that's a 25% gain, right, in my investment of $100,000. Because again, so hopefully this makes it clear, I've invested in a $500,000 property, but I've only paid $100,000 out of pocket, which I'm going to get back. That's my principal, investment, right? There might be some, closing costs and stuff that I will lose, right? I'll have to gain back through this, formula here. But for the most part, this $100,000 on a down payment, if I just consider that, is going to gain me about 25% a year compounding. Okay, that's what makes this so powerful in terms of investing in property. Now you're going to be thinking, well, wait a second, I've got to take out a $400,000 loan in order to buy that property. Well, yes, you do. But that's, again, what makes property so incredible. Not only is the bank or a lender going to give you a $400,000 loan, and usually like 15 minutes, because it's based on your credit and your DTI. We'll explain about the DTI in a second, your debt to income, how that's offset by the rent that you get. But that's what this is all about. Someone out there is going to rent that property. And so let's say that your $400,000 loan is going to cost you $3,100 a month. I'm throwing out numbers here, so of course you'll work with your lender to get the specifics. But let's say it's going to cost me $3,100 a month in order to have that loan. Well, I can find someone to rent that property. Let's say at the beginning, I'm only going to find someone that would pay $3,300 a month, right, for that. Well, if you think about it, I've got someone else giving me the money, 80%, right, of the money that I need to buy this property. And then I've got another person, a renter, paying that loan for me every single month. Where else are you going to get an investment like that? I mean, that's what makes this such a powerful opportunity, is that someone else is actually going to pay for your investment. The lender is going to become an 80% partner of yours in your business, but they're only going to ask for whatever interest rate you're getting that at. Even right now, it's 6.5%, let's say, right? That's a very small amount to ask. If you were to get a business partner and they were an 80% partner, how much would they want? They'd want 80% of the company returns, right? Or the returns on that investment. The bank's not saying, I want 80% of the returns that you're going to make when you finally sell that house. They're like, you can keep all of those returns, but all you're going to pay me is 6.5% APR every single, time you make a payment. 6.5% going to go to that. It is amortized over that time period. So sometimes it's front loaded, meaning you'll pay more interest in the beginning than in the end, but don't worry so much about that, because for the most part, this $3,100 a month payment that you're going to be paying on that mortgage is going to be covered by your rent or your renter. Okay, now if I look at a kind of a graph like this too, my rent is also going to go up probably 3 to 5% in most markets every single year. But my mortgage, even if it's higher a little bit at first, is going to be a flat rate all these years. Most people that are property investors get scared to death, like literally freaking out about this initial part right here. Oh my gosh, it's such a risk, and I'm going to pay more money, and I'm not going to cover as much rent. And if you do a cap rate, and they get all worried about things like that. This is an investment that you're going to keep for time. We always do 10 years is what we project out what it should make, and we anticipate, and I'll talk to you more about this, how we figure this all out. But we want, at least in our investment strategy, because we're just buying homes that are going to sell for a lot more money down the road, and that's what our investment's for. I don't need a big amount of cash flow coming in right away because I've got my own job, I've got my own income. I'm just trying to make a great investment for the future, right? Like many of you, hopefully, that are watching this. So we freak out at this point. You get 5 years down the road, or you get 10 years down the road. I have not met a person yet that is invested in property that held their rental property for 5 or 10 years that didn't say, I can't believe I didn't do this more often, right? Anybody that gives it up sooner than that, they'll come over here and they didn't follow what we teach in terms of getting the right people in there, or something happens, or they make bad decisions because they didn't know any better, and they have issues over here, and then they sell right away and they lose money. So you will hear some horror stories along the way. People didn't pay my rent, they destroyed my home, all this kind of stuff. You can really get over that, believe it or not. And the most they're going to ever do to your home is cosmetic. It doesn't cost near as much as what you're going to earn. But usually in a 10-year period, we're talking somewhere around $200,000 in what we're going to cash out in terms of profit from this property if we keep it for this period of time in most markets. And again, we'll get into those kind of decisions that you'll make to make sure you're in the right market. You're looking in places that are continuing to grow, things like that. And we'll help you to do that. Contact us and we'll be happy to walk you through some of that. So out here in our Utah market, we've got certain areas like Vineyard, like Eagle Mountain and Saratoga Springs, even further south in Mapleton and Springville. Great investment opportunities out there. Vineyard we like because of the university students. Even down in Bluffdale, where they've gotten the prison has been moved out and they're building out there. Basically, these are up and coming markets that are going to give us the opportunity to buy still at a good, introductory rate or acquisition cost. And then we anticipate this kind of growth, projecting forward. Okay, so to be clear about what I'm talking about here is that if I only invest out of pocket $100,000 and this property appreciates on average, especially over a 10-year period, because that's my anticipated time that I'm going to keep that property and rent it out, which, by the way, is not hard to do. Don't worry about being a landlord, and don't feel like you have to get into a property management scenario and lose even more money. I'll teach you how you can manage your own property. Sorry, property managers, but if you've got less than 10 properties, which is where you want to be as just kind of an average investor, and you're able to get those through your traditional lenders, and you've got them close by, for example, you can manage your own properties easy. It's a lot less work than you think. I probably spend maybe 5 hours a month, if that, on my properties. And I have multiple properties here in this area. So it really doesn't take that much time. But we'll go into the kind of those specifics as we keep going through this. So at least here again, you've got a reason to invest when you set it up this way. Don't pay all cash for the properties. Put 20% down. Out of pocket is only $100,000. Let your renter pay the rest of it. You'll increase rent over time and the cash flow will get a little bit better. But know that any money you're putting as far as down payment, or even any money that you initially have to kind of put into the property in terms of what you're pulling into it to pay that mortgage, is all an investment that's going to appreciate over time. Okay. So now let's get back to what this HELOC thing means. So what I'm going to do is I'm going to use the HELOC to pay my down payment. Okay. Because I don't have, if I don't follow that other model of having all this savings and checking account, I basically, my finances in my home, our family finances, and again, we'll talk about things about protecting your investments and separating them from personal assets and family and things like that, or income. But my finances are managed through this HELOC. I don't keep this great big savings account. I don't need to. If I want to tap into money, I've got hundreds of thousands of dollars. Let's say I've got 400K in a HELOC here. If I ever need money for whatever that I need that isn't being covered through my regular budget setup, right? What I make compared to what I spend each month, then I can always tap into this anytime I want. But then I'm not losing money or spending money, right? That is not going to help me in terms of my investments. I want my money working for me and making money as I invest it. So I can tap into this anytime I want. So there's no need for a savings account. I've got a line of credit that I can tap to in any way that I want. Got it? Okay. So let's say that I pull out $100,000 in order to buy that property. I know that it's going to cost me 7% to pull out that $100,000. But if I'm going to make, if I've projected it out, 25% annually, right? Because this is an APR. If I'm going to make 25% annually from that investment, it obviously is worth that 7%. You don't have to add what you're going to be paying in interest rate on that loan that you're getting for that property, because remember, your renter is going to pay all that. Your renter is going to cover the principal, the interest, the taxes, the insurance, everything in terms of the rent that they're paying. If there's a little bit of money that you have to cover for it at first, you might have to factor that in. But for the most part, I'm talking about the difference between a 7% payout with a 25% return. If you could spend 7%, with your money in terms of a loan and make 25% back from the investment, you'd do that all day long. That's 18% profit margin that you're making on that. Does that hopefully make sense? Okay, so with this, I'll just leave that up there. You probably at first aren't even gonna have to pay a full $100,000, because as I work with a lot of my clients, they've literally got remember that savings account? You have your checking and you have your savings account over here. They've accumulated. I've talked to clients that had over 100K just sitting in their savings account. Unbelievable. Literally just sitting there in their savings. Some of them were smart enough to put it into a light investment, maybe a money market account or something like that, but they felt like I need to tap into this anytime I want, right? But isn't that what a HELOC is? It's tappable income, or tappable money that you can get to. So you don't need all this, but a lot of times they already have 100 grand. I've actually had several of my clients literally just take money out of their savings and pay for the first property and not even put anything into their HELOC, right? Which is crazy that it would be sitting there like that. I've had first-time buyers that have literally saved up $50,000, $60,000 waiting to buy that first property because they didn't realize they could leverage first-time buyer grants and no interest or no down payment or very little down payment options. So whatever that money may be, let's say you've got 40 grand just sitting in there because you were told you need to have that in case something were to happen, right? But obviously you've got this, okay? And the more properties you have, the more this, your equity has that you could tap into. If at some point you want to have something easy to get access to, typically what I have in my stocks and what I have in my commodities, even if it's in, an IRA, type of thing, but I do a lot in my Roth IRA, which is tappable too, because I can pull that money out because it's after income investments, and even the interest that it earns from that, I can pull that out before my, or at least what I put into the Roth IRA, I can pull out anytime I want without penalty. So hopefully you understand that too. Sorry, I'm throwing so many things at you, but this is super important that you understand how this kind of financing setup all works, because this is what makes investing in properties, at least for me, so profitable and so easy to do without having to have a ton of money just sitting around, or having to manage my expenses in a way where I've got two loans on my investment properties, one for the down payment and one for the mortgage of the rest of the home. Okay, so let me show you how that works. So let's say that someone has $40,000. Let's say that they just want to feel comfortable. They want to keep $10,000 sitting in this easy to access fund. And I get it. I've even, in a lot of cases, I'll have savings account, like a money market that's got kind of that money. I do some trading. So anyway, I totally get it. If you want to have some money that's more easily accessible, that's fine. But let's say we take $30,000. And so we're only going to borrow $70,000 for this first property. Okay. Again, I'm throwing out round numbers. I'm not your lender. You can talk to your lender to get the specifics. There will be, of course, some closing costs involved with that, but I just want to keep things round and easy. Okay. So let's say I take $70,000 and I use that as a down payment. So this is going to be my down payment on the property that is $500,000. Okay. Now, if I put this into my HELOC, you're thinking, well, so I've got a 7% interest. Even if I pay interest only on that, which you can do, I'm going to have to pay something every single month towards this. If I'm only going to get $3,300, let's say, for rent a month, and my mortgage just on that property is $3,100, I've only got $200 to work with, and I'm probably going to need that for maintenance, repairs that maybe come up, or whatever like that at first. So what I'm going to say to that is that if you manage your finances the way that I do it, this right here, every time I get paid, so every income that I have, instead of putting it into my checking account, so here's all my income, I put all my money into this HELOC to pay it down. So basically every single month, I'm paying this sucker down. Probably if I got 10,000, we'll go back to that 10,000, I'm taking $10,000 a month off of what this is. That actually, at least in terms of the cycle, if you want to learn about when your HELOC is looked at for what you're going to be due that month, what you're going to pay the 7% on, right? You can actually pay less, based on the amount of money that you borrowed in that interest rate. That's one way that this works really well. So I'm going to, as soon as the income comes in, and now usually we get paid like 2 times a month, right, on your job. And then you're also going to get paid on your rent that comes in once a month. And let's say you have another income source or something like that, whatever it may be, you have 2 incomes between you and your spouse, you got 4 times, income is coming in, all these times the income's coming in, and it keeps paying this down whenever that comes in, right? Okay. So you're basically making payments. Like right now, if I look on my HELOC, I don't have a payment that's due, that's actually due compared to what, they're trying to collect from me for like 8 or 9 or 10 months out, because I keep pushing money into it. So I don't have like this monthly payment that I got to figure out how to put into my budget, because I'm just putting the money into this, right? Now, of course, I still have, there's still a balance there and I'm still paying 7%, but I've already factored that into my profitability that I'm going to make, that margin of that 25%. Now, of course, every single time I have money coming in, once a month, I have money that comes out to pay my bills. So let's say that my bills cost me $9,000 a month. So my income is $10K a month and my bills are $9K a month, let's say, okay? And that, again, number will increase when you have your first property. This could be an income of like, 10 plus the 3,300, that's 13,300 income, but you're going to pay the mortgage of the 3,100. So you see what I'm saying here? So this is all your bills, both your personal bills as well as your business ones. Now, we'll talk about this later, but I still put a good separation with an LLC, and also with the credit card I use only for my properties and stuff like that. You can still separate it. I know they say don't mix your business with your personal funds, and I get that, but if you talk to your CPA, they can work it out to where there's not that kind of mix that is typically there when you're using the same bank account. But this is how I've set it up for it to work. But talk to your CPA if you have any questions about that. So if I'm going to pay $9,000 a month, then this number or this amount, like it decreases this much when I bring my income in, but then at the end of every month, it starts to increase again, but not quite as much. Remember that $1,000 a month? See the $1,000 difference between the two? I'm basically etching down my HELOC $1,000 every month instead of putting it into a savings account that's not earning me any money over here, right? Or I'm losing money because inflation is more than that. I'm actually paying this down little by little. This actually gets chipped away, chipped away, chipped away, less interest that I'm paying. I'm not, putting my savings into a non-interest bearing, account, plus then using that money to buy, oh, I've got a ton of money, so we're going to go on a Disney, vacation when I don't really need to. We can have a fun vacation and not spend money. We spend money typically when we feel like we have it. But if you're doing this as a savings and an investment thing, you shouldn't be spending it so freely, I guess, is what I'm saying, right? We make different decisions when the money's not just sitting there waiting for, oh, we got extra money, let's go do this or do that, okay? So as I put the income in here and I pay my bills and I get an extra $1,000, this continues to etch down and etch down, which is really awesome how that works. Plus, I don't have a monthly payment towards this account that I have to worry about, that extra loan, because this is a loan, right, that you pulled out at 7%. But I know once I sell my property, the appreciation gain that I'm going to, or the equity gain that I'm going to make is going to completely make this all work and be worthwhile in terms of my investment strategy. So I'm going to just keep doing this and keep paying this down. Now, once you pay it down enough or another opportunity comes to add another property, just remember that everything that's above the line here, as long as you're living within your budget, is an investment. You can say, I've only put money in here because I've invested that money, right? If you keep paying this down $1,000 a month, and then let's say 6 months down the road, so you've got a $6,000 that you pay, that you've kind of attributed to this pay down on your HELOC, you've got to put new tires on your car and it costs you, $2,500. Well, yeah, this will go up a little bit, right? But it's not going to go up as much as the 6,000 that you put in there. See how that works? You're not basically just putting money into a savings account hoping or wondering if you're going to need it. This is actually going up and down based on needs, but you're not paying an interest rate on that unless it actually is an investment or something that you actually need to do that you don't need a savings account to kind of hold there for you. Hopefully that all makes sense, okay? So on the mortgage itself, obviously, like I mentioned to you before, you don't have to worry about the payment on the mortgage if you've got renters in there. Now, I know some of you are going to think, well, what happens if I don't have a renter in there? Yeah, you should have a reserve. This is your reserve. Sometimes things could happen. In the 25 some odd years that I've been renting, I hate to say it because maybe it's just a luck. Because of the way that I set up, the way I advertise and market my properties, the deposit that I have people put down, the people that I get into my properties, and I've had as much as 9 properties at a time. So I don't keep a huge, big portfolio, right, of properties. I'm talking about 10 properties or less, and there's a reason for that. And if you get into the bigger ones, I'll get Brett Mills or someone other, experts that can really talk to you about that. But for me, 9 or 10 properties that are paying themselves, off through, the payment per month by the, the person renting it, and the appreciation and, all the equity gain that I get from it, that's a ton of money, a lot more than I've even put into my stocks and my commodities that I could save up, even if you do a 401k match or something like that. So it's been a huge benefit to our finances and wealth building, okay, to do it this way. But, I was saying, in the 25 years that I've done it, I have not had 1 month in that whole time where I didn't have a renter in there paying. Now, again, I don't want to say that's going to happen to you. We've been so careful about who we get in there. And we've got, we had someone that moved out really quickly, and it took us a few weeks to get someone into the property. But the way we market and sell our properties, like we market and sell homes that we're going to sell, actually, right? For what we do for selling and renting, we do the same. Drone footage, Matterport, staged properties and stuff like that. We rent our properties like this, and we don't pick up depleted properties or properties in bad areas. We don't deal with the low income properties. We want a property that we know in 10 years is going to make a lot of money. So if you work with us, we'll teach you how to go ahead and do all that, right? So I've never had a time where I haven't had that covered. Like that one I just told you about where it took us 3 weeks. Well, because they just left on us, we had a full month's deposit that they left with us, and we used that to pay that off, and we got to keep the whole amount, right? And to be able to get that next person in there. So we actually made a little bit of money, but there was, of course, the time and effort that it took for us to, find that new renter. We did have a couple of properties that had some damage that was done that we had to use our insurance and things like that, but we ended up ahead on every one. We'll get it to that, maybe in some other discussion, but I really haven't had any of those issues that a lot of people run into. But what I really wanted you to understand today in today's little session is that you can buy properties with the equity that you have in your home currently right now using a home equity line of credit, so a HELOC, right? You won't have a second payment that you have to worry about on your HELOC because you can use your checking and savings strategy. You can scratch that and put it into this. Basically, if you think about it like a business has a P&L, profit and loss statement. That's how they manage their business, and a balance sheet. And I want you to run your home basically the same way. You don't need to have a bunch of money just sitting there losing you money. Let that money work for you. And you're going to put a down payment from your HELOC, right? And you're going to manage your finances this way so you don't have that extra payment and you're paying less interest. This is how I paid my house off a lot faster than most people pay their properties off. And then I use the equity from my property because it's a property that I live in, so I even get a better interest rate because it's my own residence. And then I use that for the down payment, and then I let the people that buy the property, rent the property, pay for that mortgage. Does that all make sense? If this doesn't make sense, please call me or talk to me. We'll walk you through how to put this together. I've helped so many people buy their first investment property, and it's kind of fun because they buy it, they get a renter in there, and they're like, oh my gosh, this is not costing me any more money. I've got it set up now where all of what I've got going on here hasn't changed anything in my monthly budget, right? Maybe they've paid an extra $200 a month, but I could do that. I was saving money anyway, but now I'm saving it better. And so when can I buy the next property? I had one that I went through this with just recently. They're already looking for another property as this property that the first property they're going to buy is still under contract and they're about to close. Because once that light bulb went on and they're like, oh my goodness, I could do this over and over and over again. Now, again, you have to be in a position that you don't want to over leverage yourself. You want to make sure that you're buying in the right areas. You want to make sure that you're buying the right property. We do a lot of empty basements out here or unfinished basements that we turn into ADUs and make them even more profitable in terms of renting and stuff like that. We'll talk about how you can do that because I know you're thinking, well, I can't rent them separately, but if you have kids in college, buy a property with every college kid, buy them a property. And not really buy them, it'll end up being them when they inherit it maybe, but buy a property, have them live in one room and have them rent out all the other rooms. We've done that with all of our college kids. It's amazing how profitable that is for us and how nice it is for our kids, and even gives them an opportunity to manage that property and get the right people in there. It's just crazy how well this works. So as I've gone through a lot of information here, if this has not made total sense to you, if you're like still scratching your head thinking, okay, how do I get this to work? Please just know it's a lot simpler than you think. I'll be happy to walk you through it. And if you're an agent trying to teach your clients how to do this, it all comes down to one, making sure that you know how to leverage equity and how to build equity, right? Number one. Number two, that you know how to manage your finances so that you're able to pay less interest and make your money work for you, including your equity, which is right now earning you zero. You don't have to sell your home unless you want to. You can, and maybe even not even sell it, but rent it out and go to your next property and still do it within the budget that you have now. And you can do it safely and without a ton of risk. And that's what the next session is about. So come back and I'll teach you how to, once you get that first property, how do you find a good renter? How do you make sure that that renter pays you every single month and has good credit, and all the things that you're going to want to look at, how you manage maintenance. I'll teach you the secret to that and things like that. But for now, start thinking about how, if I've got equity or if I'm not building equity because I'm a first-time buyer. We actually recently helped a first-time buyer buy a property where they had basically a mother-in-law suite. They're renting that out. and they're actually offsetting their mortgage that they're paying less that they were paying in rent for a one-bedroom apartment. They now have a two-bedroom, two-bath upstairs that they stay in, and a one-bedroom, one-bath downstairs that a renter has. They're renting it to someone that they know, so they feel comfortable with that, and they're actually paying less per month than they were paying with just that one-bedroom rental that they had before. So this is a great way to build and grow wealth. Give me a call. My name is Mike Anderson. We got a whole team that can work with you. Call me at 801-867-5321 or DM me, text me, whatever you want, and let's get you started.